Hello, everybody, and welcome back from summer holidays. My name is Björn Salm, and I'll be your host today. I am joined by Philip Ripman and Ellen Andersen, who will be talking through the global solution strategy. We plan to use about 30 minutes and then leave some time for questions at the end. The whole session will be recorded, and the recording and the materials will be sent afterwards. You can ask questions throughout the whole session. You can use the chat function for that, and you can also be anonymous. I will read up the questions at the end. So without any further ado, I pass on the floor to Philip and Ellen.
Thank you, Alan. Now, for those of you that have joined us previously, we'll run through a couple of the slides just to get familiar with the strategy and go over some of the kind of core framework as we usually do. And then we'll delve into a little bit of macro conditions, looking specifically at what's been happening over the past quarter and perhaps some of the events that have been in the news quite recently. And then we'll go into some of the performance in the fund before we round off with a little bit regards to the themes that we invest in and some of the companies. So very quickly to start off, let's just see in terms of the team. Now, I'm sure you're all familiar with us by now, but like I said, or like Alan said, I'll be joined today by Grieg Andersen, and we'll bring you through the presentation as a whole. And to start off, so I think it's still valuable to go back to the original framework just to remind everybody that this is where we're coming from, the Sustainable Development Goals and the framework that was put in place in order to achieve a sustainable future. I really do think with the recent events, and I'll get back to that a little bit with the IPCC report that's just come in, that it becomes more evident that if we are going to reach the target of the Paris Agreement, so a future of 1.5 degrees warming, then we really have seen an increase in urgency over the past few days. And we'll also talk a little bit about developments connected to the EU Action Plan for Sustainable Finance. We'll mention a little bit in terms of the social taxonomy, which is also coming up, which is an added and perhaps a little bit of a different view on some of the issues connected to ESG. There has been a lot of focus on the environmental side, on the green side of things, and not without due course, given the performance of that segment over a long period of time. But what we see from a longer term perspective is the social aspect coming in much more strongly, not just in a specific theme, but really also looking at issues within even the green segment, such as access to electricity as a key issue, and how the EU SFDR and the social taxonomy addresses some of these issues. So again, using the Sustainable Development Goals as a framework, we've basically derived 4 major themes that we do invest in across climate change, sustainable cities, empowerment, and responsible consumption. Obviously, climate being the kind of very green-oriented heavy aspect, looking at renewables specifically, and empowerment being the kind of opposite representative on the social side of things. But it is important to state here that ESG is still relevant across all of these themes. They're not just crystallized in one theme or another, but it does make its entry into each and every one of these themes. For those of you that have been with us previously, I'm sure that you're aware of the sub-themes that we currently do invest in. I think, like we said, in terms of climate change, it is a play on solar energy, wind energy, grid and infrastructure. Again, going into sustainable cities, looking at water, urban planning and mobility. Both very interesting areas also in terms of the infrastructure plan that has now been agreed upon in the US, putting some of those issues really into context. Responsible consumption and really focusing on a circular economy and empowerment, really bringing forward that social aspect and access to basic services such as telecom, health and finance, which again is reflected in the EU SFDR and social taxonomy draft that was released not too long ago. So maybe just take a moment to reflect a little bit around the IPCC report. For those of you that follow these issues closely, it was, I'd say, very somber reading. It is a huge challenge for us going forward. I think, once this has been put into context, the real urgency of now seeing really transformational change at society at all levels becomes very clear. The time frame becomes even more squeezed than previously. I think once we were talking about 10, 15-year plans, they really need to be able to accelerate some of these plans at a societal level going forward. And I do think if we think about the reports at large, it does put pressure on the COP26 meeting later this year in November in Glasgow, We need to see a positive result coming out of this. And we need to see a result that really reflects the report in the best possible way. But also, I think if we take a minute to reflect on it, it also identifies what areas we need to grow. And I think this is where the solution side comes into play. These are areas that we see that can deliver some of the solutions to these areas. And again, from a societal point of view, we know that these are areas that we need to grow going forward to meet the challenges that we face also from a climate change point of view. And then on the other side of that, we also know what parts of society, what types of business we also need to basically remove and get rid of. And we see now that fossil fuels are a problem, not only in a long-term context, but really in the short term. We need to ensure that the electrification and renewable side really does take over and make the need for new fossil fuels obsolete. And yeah, it's becoming more clear what parts of the economy we need to get rid of. And I think all of this plays into the fact that if we are going to grow a section of the economy or section or subsectors or whatever categories you wish to use to describe this, we need to focus on this type of solution aspect much more going forward. So dive in a little bit. For those of you that were with me in the previous meeting, we did talk a little bit about what was happening in part of Q1. Now, obviously, at that point, we were still talking about, the reopening side of things, but COVID was still an X factor, which I believe it still is in this quarter that we're in at the moment. And we were putting an emphasis on perhaps rebounding some of the transportation stocks. We see that hydrogen is becoming a bigger topic and still is. But really, Q1 was dominated by an aspect of both the value rotation that we saw into the markets, where value stocks were making a rebound and growth stocks weren't performing as well. And also the green segment at large was underperforming at that point, but coming on the back of a tremendous performance from 2020 and into the beginning of the year. And then beyond that, we also saw inflation, and the fear of inflation really set itself into the market, which I believe once we've now moved into this quarter, we're not seeing quite as much of that fear of inflation as we have been perhaps during the first quarter. I think at the moment, the dialogue is obviously dominated by the IPCC report that came out through and how we're going to deal with that. I think it brings into an aspect some of the issues connected to climate change adaptation. We have perhaps talked a lot about mitigation and stocks that might be delivering solutions on that side of things. But I think it is going to bring into it much more a kind of adaptation view, what stocks are out there basically building for a future that does include a certain amount of global warming. Moving on from that, I think if we look at some of the kind of macro level issues in the quarter and moving into this quarter as well, obviously from a Biden and a US perspective, the infrastructure plan coming in now recently is going to be or generate positive momentum, I would say, for quite a large section of the type of companies that we're looking for. It's specifically interesting on a kind of water, energy, transport nexus, where the US is going to be spending considerable amounts of money and upgrading certain aspects of infrastructure within the US. Going on from that, there is obviously a lot of attention on the relationship between the US and China. I think it's interesting to see there's at least two kind of issues playing itself out within the portfolio, but also the kind of macro level. One is basically the supply of polysilicon coming out of certain parts of China, and to what extent there has been any kind of link to forced labor, which is an issue that we are keeping a very steady eye on at the moment. And there has been some then discussion about how the US is going to handle polysilicon imports from the Xinjiang region. There was a pressure towards getting American companies to not import polysilicon from these areas. And it is a vital part of the supply chain for many of the companies, not just here, but throughout a kind of world index point of view, specifically within chip makers in the solar industry, which use tremendous amounts of polysilicon in their products. So I think that's an interesting thing to keep an eye on. And obviously we'll see what China's response is. We're seeing another issue as well, which is obviously the kind of tech crackdown that has been in the media a lot. Where we're seeing basically China reassert its authority over its economy and over some of the larger companies within its economy. Now, for anybody who follows China quite closely, I don't think this comes as a big surprise. I think it's often one of the misconceptions that China is on a route to kind of a liberal democracy type idea, which I don't think is the case. So in many cases, this would be the fact that tech companies have grown a little bit too large, and China wants to make sure that we know who's in charge of the economy and who sets the kind of playing field, if you wish, for these types of companies. Now, we do believe that some of the aspects are warranted. Some of the aspects of these big companies need to be regulated in a better fashion than they have been previously, specifically kind of financial market entries, how consumer information is used and shared within these companies. So some of this I view as positive, and some of this I view as some of the companies being better able to navigate than others. So it'll be an interesting issue also to keep our eyes on going forward. We're seeing, like we said, inflation kind of fears calmed down a little bit. And now, again, I would say one of the big places to keep an eye on is really the run up now to COP26 with the release of the IPCC report. But at the same time, we also see now, not only globally and within Europe, but we do see in the Nordic region as well, COVID rates increasing again. And I do think that's a little bit of an X factor now in terms of, yes, we're seeing kind of lower rates of serious illness, especially in areas which are highly vaccinated. But we are wondering what the fallout will be in terms of the kind of reopening plans that many of the economies have on the agenda. Will there be a slowing down to those or not? And it seems to be a little bit varied at the moment, but it's again something that needs to be kept an eye on. And then I think going forward from this, the social taxonomy draft that was released not many days ago is an issue well worth discussing a little bit further. With that, Ellen, would you like to say something about this aspect?
Yes, sure. Thank you, Philip. So as Philip briefly mentioned, the Platform on Sustainable Finance released a draft report on the social taxonomy in July this year. And the purpose of this taxonomy is to direct capital flows to entities and activities that operate with respect to human rights, but also improve living conditions, especially for the disadvantaged. So the social taxonomy is recommended to follow the same model as the green taxonomy, where that is possible. And there are many reasons for this, because going forward or in the future, we would likely see more funds that have a social aim or an environmental aim, or both. And then to make it easier for investors to compare which fund is aligned with the taxonomy or the social taxonomy, environmental taxonomy, or both, make it easier for the investors. It also will make it less of a workload for investors to having to manage two completely different systems. So even though the aim is to make them as similar as possible, that won't be possible to every extent, because as the green taxonomy, the foundation of this taxonomy is based on natural science and international frameworks such as the Paris Agreement. But a social taxonomy, however, cannot be based on science in the same way. So while the science behind climate change gives a clear answer to CO2 reduction, the science within social sciences are not able to be as detailed as that. And although there is a lot of research within the social phenomena and within social sciences, this would definitely influence the development of the social taxonomy, but the science, as I mentioned, will not be play the same part as it does in the green taxonomy. It will also, for that reason, be more difficult to develop these quantifiable criteria for the social taxonomy than it has been for the green taxonomy. What is interesting to see, especially after the pandemic, is that there is an increasing interest for social investment. There is evidence that there is a rise of social bonds, and recent data suggests that this trend will grow. And the pandemic has also shown that private investments can be crucial for social progress, because it was the private investments coupled with the government support that made it possible for companies to do medical research and so to develop the COVID-19 vaccine. There are also fundamental economic reasons for social investments. Even though there really isn't any consensus on the strict relationship between inequality and economic growth, there is increasing evidence that the growing gap between rich and poor could impede growth. And that also includes the possibility of creating political and social instability. So therefore, a social taxonomy is much needed at this moment in time, and we expect to see a significant development on the social side of ESG alongside environmental. So if we go to the next slide, we could see that the proposed or a part of the proposed structure for the social taxonomy, they focus on products and services for basic human needs and basic infrastructure. So here the objective is to promote adequate living standards, and that includes improving accessibility of products and services for basic human needs. So this objective has been a part of the Global Solutions strategy from the beginning. And some of the thematic examples that you can see on the slide here, we also have identified as solution themes, or they're identified in our solutions database. Now, this is, of course, just a draft of what a taxonomy could look like. So these are example and not exhaustive, but several of the proposed thematic examples are in line with what Global Solutions are looking at. So we are optimistic for this taxonomy, and as I mentioned, a much needed focus on the social side of ESG along with the environmental part of ESG investments.
Thank you, Ellen. So I think also, like, having done a first kind of preliminary look at this draft, I mean, it's very uplifting to see that I think we're very much in the right spot as things are at the moment. Obviously, as is the case with the SFDR in general, on the greener side of things as well, you know, this is subject to change. I mean, we are waiting for more, let's say, a more extensive report to come out, but I think in principle, it looks like we are pretty much in line with the way that we have been thinking about these things over time, as Ellen has said. So a little bit of notes in terms of then going into the performance aspect of the fund. We did see a value fall off in June. So as value has been a good performer throughout the year, with the exception of maybe a little bit at the beginning of the year, we're now seeing growth basically back up to standard in terms of the dimension or dichotomy between value and growth. Now, we do have a growth tilt in the portfolio, and that's evident when we look at performance, especially in Q1 that we covered in last meeting, that we saw a drop off during February from about mid-February and on. And we've also seen a very positive quarter now, and we assume positive quarters going forward as growth has gained momentum again. Green stocks have been performing better, specifically in June has been a good month for kind of green stocks in general, but there seems to be quite a lot of market reaction to not a lot of news flow on some of these companies. So some of the company results coming in have been quite good. They've reaffirmed some of the growth cases that we've had that are in line with our thinking, and yet maybe missed on a couple of key metrics and been punished quite severely by the market. Over the last quarter as well, we do see that a cluster centered on kind of sustainable cities that includes Johnson Controls, Comfort Systems, Owens Corning and Signify. They've all been doing very well during this period and kind of lead the fund in terms of performance during that part. And sustainable cities has been a kind of well-performing theme for us really throughout the year, but also throughout last year. So if we go in and just have a look at the year to date, and like I mentioned, in kind of mid-February, we saw the drop off if there was a kind of value to growth, growth to value rotation, I should say. And then we've seen over the past quarter that we've clawed some of that back and that we're doing very well. And this will be the quarter just isolated throughout a period in then April and May. We've now had a positive quarter, which is calling back a little bit of that loss through Q1. Not to mention too much, we're still ahead from a one-year rolling point of view, and I think we are very well positioned for the future. I think when we talked a little bit about the macro statistics and the macro events going on, I think with the advent of the COP meeting, the infrastructure plan coming into effect, it's somewhat similar to really last year, where we saw perhaps performance not being the best at the beginning of the year, but picking up momentum as the year went on. And I think there is enough positive momentum in terms of the macro trajectory that we'll be seeing some good performance as time comes in. We're still slightly underweight North America. We did make some changes in the portfolio, bringing up, I think, a couple of the companies that we would assume that would do well under the infrastructure plan. But again, if we see the sector weights, as we've discussed previously, I think this is just evidence again of the diversification in the portfolio. We will and will always be at zero weight in terms of the energy sector, but then you will see that we have a nice spread throughout the others. Industrials and IT are still overweights and will remain so given the kind of cluster centration in industrials when it comes to really everything green tends to be grouped into that. But again, the diversification within the industrial sector is quite large, so it doesn't strike me as much of a concern. And the overweight is there for IT as well. But again, spread throughout the kind of 4 themes with different types of drivers attached to these types of companies. So we still believe we're well positioned for being a diversified portfolio across these 4 themes, which we've previously emphasized. So to kind of delve into a little bit of the attribution, looking at the various themes that we do invest in, as we see climate change, renewable stocks came kind of well back in June, which was pleasant to see. Sustainable cities has also been a general positive contributor throughout the year, also in terms of responsible consumption, perhaps with the exception of February, but generally very happy with where we are with the themes at the moment. Now, there is always room to improve. There's always room to improve across the board and across the whole portfolio, which we will be looking at, but we are happy with where the 4 themes are at today's date. And I think then going across some of these issues, we've talked a little bit about theme, we've talked about value chains previously. Again, a kind of remark on size as a whole. We do have large caps, we do have mid caps, we do have smaller companies as well. There is a small cap tilt in the portfolio, as previously mentioned, but we do seek to be in all of these types of companies, given that these are types of value chains that we do have or that we have identified as will benefit from the trends and the themes that we've talked about. And for those of you that are perhaps new to these types of presentations, just to quickly mention when it comes to our investment process as such, we do include a quantitative approach. And I think, to link it back to what we previously talked about with the SFDR, I mean, information is getting a lot better from an ESG point of view. There's still a long way to go on several of the topics, but I think the trend is generally clear that it is getting better over time. And it means that we can utilize more of that data in narrowing down our investable universe. But we still rely very heavily on the qualitative side of our researchers, of our analysts, to be able to basically identify stocks that fit into our investment universe that are solution companies and that are aligned also with the EU taxonomy in principle. And then to be able to identify out from that an investable universe that we can pick through is one of the key features of our team and where we spend a lot of our time today. Now, we've increased the number of companies again into the solutions database, which is in many terms our investable universe. These are companies that we have identified as solution companies that have alignment to the EU taxonomy and that we do believe are well positioned for future growth within these segments. Now, there's various ways where you can get identified as a solution company. I think obviously some of the recent additions to this database are small cap companies as we continue to kind of broaden our view on some of the value chains and look for new investment opportunities across them. But also there will be advents of mid caps coming in. Perhaps there will be new sub themes that we identify that we would like into the solutions database. And obviously some of the work that's being done through the SFDR, both on the environmental and the social side, can add to some of those sub themes, or at least crystallize that these are sub themes that are in focus and can give us an input to where they're headed. And then there might also be the case of large caps transitioning in, from one area to another. Now, I don't think we've seen too much of that at present. From a transition kind of play, we often talk about specifically Dong or Ørsted Energy that have managed to kind of transition from one sector to another or one business activity to another. But I think as the IPCC report puts very clearly, we need to see more of that if we're going to succeed in the future. So it'll be interesting to see if the investable universe as such grows from that perspective as well. And again, just to see a breakdown on different topics, we currently do have a number of companies on the climate side of things and sustainable cities. So there is perhaps a slightly overweight within the investable universe on the green side. That's also in line with both our thinking and the way that we've been talking with you previously about these issues. There are, and I think Ellen covered this quite nicely, perhaps less scientific basis for some of the issues on the social side than there is on the green side, although there is consensus upon which areas need to be improved and where we need to see additional funding for us to succeed with the Sustainable Development Goals. And with that, Ellen, I'll leave it over to you to bring us through some of the sub-themes.
Yes, thank you. So now looking closer at one of our themes, empowerment, just to bring it together with the social taxonomy, as I talked about earlier, because empowerment is mainly about the social side of ESG. And we do see a lot of the topics that we have under the empowerment theme that goes in line with the new social taxonomy. And I will now talk about one of them, which is access to financial services. So under this sub-theme, we identify companies that offer microfinance, that is loans to individuals or micro or small and medium enterprises or SMEs. And we identify fintech solutions or companies that offer fintech solutions, because that enables these small and medium enterprises to sell their products and services in a cost-efficient way. So, as mentioned earlier, the pandemic has really shown that private investment could be crucial for social progress, but this has also been apparent before the pandemic. For example, we know that microfinancing and targeted investments in SMEs have shown how private investment could play a part in lifting people out of poverty. And also research suggests that where there are a high level of access to microfinancing in countries where those levels are high, there is less poverty. So this is why we have identified microfinance as a category. And so one of our solution companies under this category is Bankrakiat, because one of their main segment is microfinancing, which enables access to finance. And they are mainly present in Indonesia, but also other emerging markets in Asia. And Bankrakiat was one of the banks who was hit the hardest because of the pandemic, and that is because their core customer base is in fact this micro and SMEs segment. But the bank do see this as a great growth potential, because Indonesia in particular is the fourth most unbanked country in the world. And they're also now looking to grow into ultra micro enterprises, which are the tiniest of the companies, because there are about 57 million of these type of enterprises, and only about 20% of these have access to funding. So this is why we view this as a solution company under microfinance, and do see a great potential or growth potential for Bankrakiat in this segment. So lastly, I will take you through another solution theme, responsible consumption and production. So for this theme, we identify companies that contribute to a more circular economy, and companies that contribute to how consumption can be made more sustainable. And under this theme, we are, amongst other, looking at companies that are designing waste out of the system, and that ensure a more continual use of products and materials. And here design is crucial, because design is really the creation of products, services and system. So it is an important part of how it shapes the material environment around us. And one of the companies falling under this category is NVIDIA, under the eco-design category. And this company is a company that we view as an enabler because it enables other sectors to produce more sustainable, because it uses artificial intelligence, for example, and this can be used to infuse intelligence into computing devices and affect every industry to create more sustainable products. So to give you some examples, I'll have, or some example of this. This can, for example, be used in self-driven cars. NVIDIA also has a program called NVIDIA Inception, and that is a program that helps startups to use artificial intelligence in their business model. And one of the companies that was a part of this program, called HeartDub, they use technology in fashion, so that they made a program that allowed designers and creators to view their fabrics and garments before they produced it, so they viewed it virtually, and in that way they can make or help clothing companies become more sustainable and achieve a zero waste manufacturing. Recently also, NVIDIA launched UK's most powerful supercomputer, and that aim is to be used for research in healthcare. Because it can use artificial intelligence to design new drugs and improve the accuracy of finding disease-causing variation. This computer is ranked as the top 50 fastest computers in the world, and it's 100% powered by renewable energy. So this type of technology, or the examples that I presented, are some of the reasons to why this company is a solution company, because it can enable other companies and give them the technology to make more sustainable products. So that was a quick run through of that, and I'll let Philip do a quick summary.
All right, thank you, Ellen. So in summary, yes, what I'd like to say is it's been a positive quarter for Global Solutions. I think we talked a little bit about the macro conditions and the events coming into Q3 and Q4, and I think that will create significant headwind for the portfolio. And I do think the social taxonomy will create, like Ellen has said, a focus on social integration across funds. Interestingly enough, not just on the social topics at large, but even on basic issues like bringing a social dimension into renewable energy and looking at an aspect like access to electricity, which will feature quite prominently, I think, within the social taxonomy framework. So I think there's an exciting opportunity ahead from a social dimension, and I think that brings into it an onus on being diversified across not just 4 themes and not just across size, but also really across ESG as a whole, which is where we've always wanted to be and where we feel we were well positioned. With that, I think I'll leave it over to Alan to perhaps round up.
Just a reminder again, you can send questions to the chat function. It's better than actually emailing me directly, but we have only one question so far, and that's really the fund has grown significantly over the last few months. Do you have any comments around capacity on your strategy?
Right. Well, I think, like we talked about, we're continuously adding to the investable universe, which means there are more and more companies to select from. There are more and more investment opportunities coming through. And I think some of the macro conditions that we've talked about will also generate more business models that come under a kind of solution context. So I think at the moment we're sitting somewhere in the region of 17-18 billion NOK within the strategy as a whole, and we would have no problems in doubling that capacity. We're also, heavily invested throughout kind of large caps, mid caps, small caps, and that is a type of flexibility that generates as well. So I think we're in a good position, and we can handle about double this at least without there being any problems.
And I guess as a clarification for international participants, that's about 1.6 billion euros you manage. We have gotten another question in just now. How do you assess risks in state-owned banks in Indonesia as a minority shareholder?
I think the state-owned aspect really comes through, and not just in the banking sector, but in several sectors, especially once we look into emerging markets. And I do think it comes into question on several accounts, one being who is the kind of primary, I guess, value generator from an ownership point of view. Is that the state? Is there a political consideration in terms of the activities that the banks or any other sector does promote? or are there shareholders there that can promote a kind of value-based approach? So I think it's on a case-to-case basis. We do have to keep an eye on these issues in every market that we're in, and for all the different industries where this is somewhat problematic or somewhat of a challenge. Yeah, and it's just important that we stay on top of it from all the different cases that we're in.
There are no further questions here on the chat. I guess we give it a couple of seconds just in case somebody has a last-minute question. Otherwise, I don't know if there's any other points you want to make before wrapping up, Philip. Nope.
I think I've spoken enough, and I think people might just be back from vacation yet. So I'm with respect to how much time we use from everybody.
No, nothing seems to have come up anyway. And like I said, the recording and the materials you use will be sent out subsequent to this webinar. So I guess with that, I guess we leave it there, and thank everybody for taking time to join us again after the summer break, and hopefully this was interesting.
Thank you.
Thank you.
Thank you. Bye-bye.